India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Middle of the week. It's a Wednesday morning. Nice and nippy here, this 8 o'clock Mumbai time. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleague Surabhi and Nigel. Guys, hi, good morning.
Is it nice and nippy? I'm thinking cupcakes and coffee. Prashant, should we look at you?
This is the most I get out of winter, right? I mean, so-called winter. And you know.
I don't know. Yeah, former Delhiite, so we know.
Although Delhi doesn't have too much of a winter to speak of now, right?
But it's starting apparently the major cold wave that's about to, set in the next couple of days over there. We're nice and nippy, not complaining.
Absolutely. For Bombay, standards pretty good. But we've got a market to address. Let's get straight to that.
Absolutely. And, so last night, Qs, not very much to really take home one way or the other. And slightly sideways. I mean, actually, the US market consolidated for the most part of the day and then towards the end dipped into the red. I mean, the change is up on your screen. S&P down about 1/3%. NASDAQ down about 1/4% or so. You got the US 10-year yield, which was up 2 basis. Everything small. I mean, 2 basis points up. Dollar index absolutely flat, 106.34. There were specific moves in tech names like Nvidia, Google, etc., but that's later. Some data. The NFIB Small Business Optimism Index rose to its highest reading since June of 2021. And, there's one thing which I think small businesses are excited about, or Trump has been kind of sort of signaling that he's going to help his small businesses. So optimism in terms of this indicator, the highest since June 2021. The other data point, of course, is going to be later, which is the US CPI. Again, as we telegraphed earlier this week, is expected to be elevated, sticky, etc. So not very much in terms of big cues. We'll see, though. Oil prices unchanged, but small down, about $72 a barrel. There was, of course, Trump on Truth Social, that social media platform, also saying that, invest more than $1 billion in the US and all hurdles will go away. We'll talk more about that later. Just to circle back and tie in the level, since there's not very much dramatically different. So, as I said yesterday, both the Nifty and the Nifty Bank by the end, and actually through the course of the day, traded above the hourly averages, the 40-hourly averages, and we ended above it. Actually, if anything, towards the end, there was a sharp ramp up and the Nifty ended absolutely flat. There was nothing to show on the downside for both indices. So the Nifty support level comes in at 24,534. This is the nearest level that we are looking at. The swing low from a few days back is 24,295, and many are quoting that. And that is also important, but let's take it step by step. Because if the 24,295, and I think we had Jay Bala yesterday in the afternoon also making that point, that if you start to trade below it, then perhaps you've got to start to question whether this move up is over. But we're not there yet. In the near term, of course, the Nifty on the upside needs to cross 24,857. Similarly, for the Nifty Bank, it needs to cross its recent high of 53,888. It's not very far away from where we left off. And of course, support here comes in at about 53,160. Gift Nifty will come up on your screen indicating how we are likely to start. It's absolutely flat. I think, befits the kind of handover that we got from Wall Street. Surabhi.
Absolutely. And perhaps why the Gift Nifty is slightly lower, the implied open is lower, is because all markets in Asia are actually red. Barring two markets which are very excited, which is China and Hong Kong. I'll get to that in just a bit. But otherwise, whether you're looking at Australia, you're looking at the Nikkei in Japan or Singapore, most of the regional markets are following that handover, that weak handover from Wall Street, and starting off cautious. So why is China excited? Because today, it's all eyes on China. This conference, economic work conference, this is supposed to kick off. And the tone was set after that press release that came out after the Politburo meeting, where the expectation was there'll be more fiscal stimulus and there will be, quote-unquote, looser monetary policy and unconventional counter-cyclical measures that will be announced. Let's see if that actually comes through. It's enough to keep the equity market excited for sure, which is why we'll watch out for some of the metal stocks here. If there's a short-term trade, intraday in anticipation of any news from China. On the US, just to put the number on the table, the consumer price inflation data that will come out, the expectation is that The increase is going to be 2.7% at the headline level and about 3.3% at the core level. So let's see if those numbers are in sync. Interestingly, by the way, while Wall Street fell yesterday, including the Nasdaq, Alphabet was very, very interesting, and it's always some big tech name that will, take the market's attention. And yesterday, the reason that was happening was because Google is now, announced a new chip. It's a new chip in quantum computing. It's called Willow. The market got really excited about the potential, considering that it is cutting-edge technology over there. So just thought I'll mention that, while the overall market was, of course, down. Coming to flows here, we had a nice buy figure from the FIIs, just about 1,300 crores on the FII side. So that was good news. Domestic institutions were also chipping in yesterday. Not a very big buy figure, but still 600 crores. So from the flows positioning, no problem. Institutions were on the buying side yesterday. In terms of some action today, apart from all the stocks and news that we'll track, Vishal Mega Mart, that's a name that people in the north would be very, very familiar with, of course. The IPO is opening out. It's an OFS. They're looking to raise about 8,000 crores. We'll tell you more about this company, and we'll get chatting with the management as well as we roll along in today's edition of the show. So watch out for this. Last but not the least, another development and one that talks about the evolution of our capital markets. The T+0 cycle is going to kick off. It's optional. You don't have to, offer same-day settlement. But this is what the regulator has been talking about, to even consider perhaps at some point instantaneous settlements, whether our market infrastructure can move towards that. This comes in from the 31st of January. It will be rolled out in a staggered manner. And what's interesting is that the brokers that are going to be eligible, they can offer different brokerages. So if you want T+0, maybe you want to pay a little more brokerage. If you're looking at T+1 and you're patient, then maybe you pay a little less. Let's see how brokers react to this. But in any case, the capital market part of the, the equity market has been so active. So watch out for a lot of the broking stocks and the wealth management stocks that had a great run even yesterday, Nigel.
Well, that's right. And, good to see that the flows picture at least is getting settled out. Domestic flows are good, and the FIs, they're not selling at least. So, that's pretty good news. What did they do in the FNO market yesterday? Well, on index futures, they added some mild shots. And in fact, in terms of long position, there was some unwinding. So the swing factor out there is close to around 10,000 contracts or thereabouts, because the longs were down, the shorts were up. They remain net short at close to around 57% of the positions on the short side. But if you pull up a chart, after 5 sessions, they actually added net short positions. Otherwise, it was just going one way, right? They were just, it was moving down. Now they've added short positions again. So there was long unwinding, there was covering of shorts. And now, after a while, you're seeing close to 9,000 contracts that have been added on the short side. The clients, they're doing the opposite, and that's been the trend. Consistently, they have been adding long positions, net long positions mildly moving up. A few sessions ago, it was at around 1.5 lakh contracts, so they're moving back in that direction. It's playing according to script right now, because the FIs are getting some shots in the system, which is not a bad thing. And the clients, well, they are buying into this small dip that we've seen in the last few sessions. Moving to the options data, then we have 2 strikes that are fairly active, 24,600 call, 28 lakh shares getting added there. And the 24,700 call as well. Since there's a lot of addition on the call side, that's where you've seen that the PCR has cooled down. It was at around 1.2, 1.25 odd. That's cooled down to around 0.85 or thereabouts, because the call writing has been rather aggressive. So some of these call writers, in case we get some positive news, well, they'll get stumped on the wrong side. And these contracts expire tomorrow itself. Which brings us to the levels. Yesterday's low we had mentioned that maybe at around 24,500. That's the point I made yesterday morning, that maybe risk reward could favor you at that level. And it bounced off there. The 50 DMA comes in that vicinity of around 24,500 or thereabouts. So 24,450, 24,500, extremely important on the downside. Well, on the upside, the resistance level you're looking at is 24,750, which is around the 100 DMA. On the Nifty Bank, we've seen the recent high, recent low. They become the important level. So that's the broad range you're looking at. Stocks that I'm looking at, well, I'm looking at Samvardhana Motherson. Because in yesterday's trading session, it conquered 2 levels, the 20 as well as the 200 DMA in yesterday's trading session. It ended around there, which is important. We saw a fair bit of delivery-based buying in the last few sessions, and there is some mild long addition as well. So the stock, remember, has corrected a goodish bit from the recent high. It's still down 20% from the peak. But yesterday it showed signs that, the street is seeing some kind of strength out there with those technical levels getting taken out. So let's see how this goes.
Right, Nigel, thank you very much for that. So that's the setup as we are seeing it. Bhaskar Lakshminarayanan, he's the Chief Investment Officer and Head of Investment Management Asia. Julius Baer now joins us. Bhaskar, thank you very much for joining us. Good to have you here on the program. It's the end of the year. Seasonals are positive. And then, of course, then we get into January in 2025. what's the broad roadmap? I mean, you think that one view is that maybe we kind of sort of drift higher into the end of the year, and then maybe January there's a bit of a reality check once Trump is in office. What's the sense?
Well, I don't know whether it's associated with Trump being in office, but overall, markets are priced for perfection. In terms of execution, you got to get everything right at this point in time. The earnings expectations are reasonably high. Also expectations of what they will announce on guidance is also quite high. So execution is absolutely key. And there is literally nothing. So if any misses happen in the next result season, I think you'll see a correction. So I think results is part of that exercise where you will see market consolidation one way or the other. Either it goes up to the next trajectory or we take a correction. But looks more and more likely that the next big event is down rather than up.
Down rather than up. Okay, that's an emphatic statement. Bhaskar, good to have a clear view. Always good to have a clear view, whatever the direction might be. So tell us specifically on India, do you think this is, this holds true for the Indian market as well, more down than up? Because here there is a lot of chatter about the earnings that you spoke of. I mean, anyway, we've come off a really weak season. Q2 was not great. Then there's an overall talk of slowdown here as well. So what's the specific call on India?
I think in India, the case is because you had such a bad earnings season and you've sort of scraped through that, maybe chances are that, the next earnings is slightly better and that gives hopes to people. And then therefore, there's a little bit more of momentum in India. Having said that, again, in India, actually, the US are two different stories. In India, the large caps are actually very reasonably priced. In the US, the large caps are expensive. While it's the exact opposite when you come to the mid cap and the small cap space. It's cheap in the US, not so in India.
Hi,
so
Bhaskar.
that's going to be the tricky one to do.
Absolutely. Got that point, Bhaskar. Good morning and welcome to the show. This is Nigel on this side. I wanted to ask you about the Fed. Do you think that they can skip the rate cut in the next week itself? Today, we have the big CPI print, which everyone will be looking at. But, if I look at the Fed futures, it's factoring in 100%, I mean 85, 89% that we're going to see 25 bips cut. Do you think they could skip it this time?
Technically, they could. Okay, and chances are like this, right? Our read on the markets over the coming, I would say, 4 to 6 quarters is there is a higher chance of inflation than recession. There is no sign of recession, right? So if the markets are doing well, the economy is doing well, chances are that you might get some stress in terms of pricing and therefore inflation. Why would you cut rates aggressively? So actually keeping some buffer is not a bad idea. And the 50 basis point already has proven to be a mistake in a way.
Strong opinions. I wonder if held firmly or held lightly, Bhaskar.
Held firmly.
Held firmly. Interesting. So just a quick view specifically about India as well, Bhaskar, because we find ourselves in a tricky spot, right? Growth has slowed down and inflation is sticky, largely because of supply side reasons.
Yes.
But it is what it is. So where does that leave us?
And you just said the absolute right word. It's supply side reasons. No amount of rate cuts is going to solve the supply side reason, right? So I don't think that's the answer. So in a way, RBI did the absolute right thing by not cutting this time, but relaxing the CRR. I think liquidity elements are clearly needed as the economy slows. I think you need liquidity support, which I think was provided. So I think the RBI has done spot on this part. And I think you should expect a rate cut, maybe if there is a bigger slowdown into the first quarter of next year, maybe sometime in March.
Rate cuts in March. So, Bhaskar, just to complete that point, you said it next year is more down than up. So on India, do you see more down? Would you allocate any more money to the equity market here?
Yes. I mean, at the margin, I think India still gets money. Okay, this is because fundamentally it's a good market. And I think you should take any kind of weakness. And should there be a correction in India on a global cycle, I think all the more reason to buy a little bit more of India. So I think that would be the way to look at it.
Okay, all right. Very quickly, Bhaskar, before we let you go, the Chinese are making those headlines yet again. They are saying they're going to stimulate the economy. 2025 is going to be better. They've been saying that actually for the last few months. Do you think it's going to have some kind of impact finally?
Yes. I mean, you saw that obviously what happened pre the Golden Week when the market went up in a straight line. This is not going to be the same, but I think there's a lot more meat to what has been said yesterday in the press release after the Politburo meeting. So I think you'll see some follow-up action. And again, believe in this, there is a big part of this market which is extreme value. There is a ton of stocks that are trading on a PE basis at half the time of the dividend yield. So there is value in this market. And therefore, but one needs to be careful. It's not a long-term thing. It's not a structural story. But I think you play into these policy, buffers that you're going to get. And therefore, it's a trading market.
All right, and people who've managed to trade in and out smartly would be pretty happy with them. But these have been very sharp moves in China.
Yes.
Bhaskar, thank you very much. Great to have you on the show today, and we hope to see more of you in 2025 as well. Thank you for joining in.
Thank you. Thank you again.
All right, with that, let's move on and tell you what's lined up on the show today. At 9 a.m., we will be in conversation with the analyst at Elara Securities to talk about the trends in the NBFC and the MFI sector. Will the MFI pain really end by the fourth quarter? At 9:20, Manishi Ray Chaudhary joins in. He is our market master of the day, so get some perspective going with Manishi. At 9:30, we talk IPOs. Vishal Megamart is opening out with its issue. They're looking to raise 8,000 crores. We'll have Guninder Kapoor, MD and CEO of the company, joining in. At about 9:50, we'll be in conversation with the management of Sai Life Sciences. The TPG-backed pharma firm's 3,000 crore rupee IPO is also opening today, so we'll get some perspective with this company. And by the end of the show, in our special segment, Indianomics, Lata today will be in conversation with a whole host of experts on the tasks before the new RBI governor as he takes charge today.
Time for a snappy break, but we've got a lot of stocks that we're tracking for you. We get to our top 10 segment in just a bit. On the other side, we're looking at Senco Gold, Indian Overseas Bank, HG Infra, NTPC Green, BEML, PNC Infra, Shriram AMC, Triveni Engineering, and Sudarshan Chemicals. All of them will be reacting to positive news flow. But on the flip side, we have Office Space Solutions. We're expecting a large rate, so that one should open up in the rate. Slip into the short break, come back. We'll get you in further detail in all of these names.
Welcome back. You're with us on Bazaar Morning Call. And now it's time to talk about stocks because there are lots of stocks that are in focus today. And our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Let's start with all that glitters. Is it really gold? Senco Gold is the company. Manglam, they're raising some money?
They are raising some money. It's a QIP that has opened today with a floor price of 1139. That's about a 2% discount to yesterday's close. So not a deep discount, but remember the stock is already corrected about 24% from an all-time high itself. The size of the QIP, we don't know until it closes, but the board in October itself had taken an enabling provision of fundraise to the tune of about 500 crores. And remember, this comes nearly 18 months after the company had already raised about 270 crore of fresh capital via IPO. The only difference then and now is the price. The IPO issue price was 317. 18 months later, we're raising funds at around 1150 odd rupees. I see positive here because one, there is not much discount. The stock has already seen a correction. And the second part is that in the third quarter, which has seasons in terms of Diwali as well as the wedding season, is typically strong for jewelry companies. So see the stock in green today.
Okay, all right, Mangalam. Thanks a lot for that. Well, let's hop across to Abhishek. He's here to tell us about a couple of names. Office as well as Indian Overseas Bank. Morning, Abhishek. Take it away.
Morning, Nigel. So to begin with, sources tell that there will be a block in Office Space Solution. The sellers are BISC Limited, Link Investment Trust as well as Peak Partners. So floor price is at 680 per share, a discount of little more than 5% to yesterday's closing price. The deal size is about 583.4 crore, nearly about 12.2% of the outstanding equity may exchange hands in trade today. The lock-in for the residual stake is about 90 days. And the book running lead managers to this issue are ICICI Securities as well as IFL Cap. Indian Overseas Bank, they have received a second time, refund from the income tax department in this quarter. So yesterday they have received an order of refund of about 1,359 crore from income tax department for the assessment year 2015-16. Now earlier in November they had also received an income tax refund to the tune of 1,238 crore. That was for the assessment year 1920. So in totality, nearly about 2,600 crore of income tax refund is seen in this quarter. Remember that the PAT in Q2 was close to about 777 crore. So they may have one-off in this quarter with respect to their P&L. Back to you.
Okay, all right. Abhishek got that. Thanks very much. So IOB on our radar as well. Vivek is watching out for a whole bunch of stocks. Let's look at his list. Vivek, good morning.
Good morning. Whole host of infra, cap goods as well as renewable energy stocks on the radar. First on the list is an infra company, Edgy Infra. The company has received a letter of award for a road project from the Ministry of Road Transport and Highways. This particular project is in Uttar Pradesh, and the company will be executing the project via the hybrid annuity mode package. The total cost of the project is in excess of 760 crore. The second stock on the radar is NTPC Green Energy. The company has received or has won a 500 megawatt solar power contract in the SECI auction, which is the Solar Energy Corporation of India. The tariff for this particular auction is at 3.5 rupees per kilowatt. Along with that, the company will also be setting up an energy storage solution system. Along with that, keep an eye out for BEML as well. The company has received an order from the Ministry of Defence. This particular order is for a 50-ton trailer supply. Contract value at a little over 80 crore rupees. Remember, order backlog currently quite strong at over 15,100 crore. Lastly, PNC Infra. Remember, the company has been barred by Mors from going ahead and actually participating in road tenders for a year. But the company has informed the exchanges that its arm, Hathras Highway, has completed a HAM project worth 738 crore. This has been done ahead of schedule, so the company will be eligible for an early completion bonus.
Okay, all right, Vivek. Thanks a lot for that. Well, let's wind this down then with Vamakshi, who's tracking a few more names for us. Morning, Vamakshi.
Well, good morning, Nigel. Let me first start off with Shriram AMC. The board has approved issue of 38.8 lakh preference shares aggregating to 105 crores to Sanlam Emerging Markets. You will in turn be classified as a promoter of the company and will acquire joint control with the existing promoter, that is Shriram Credit Company. This attracts an obligation of a mandatory open offer, and therefore Sanlam as well as SCCL have announced an open offer for acquiring nearly 26% stake in the company from the public shareholders at an offer price of 270 rupees per share. Triveni Engineering is the next one that I'm watching out for, and that is because they will be amalgamating Sir Shadilal Enterprises into Triveni Engineering. Keep in mind that both of these companies have very similar operations, verticals of sugar as well as distillery, and this in turn will lead to consolidation of operations, operational synergies as well as elimination of duplication. In addition to that, they've also decided to spin off the power transmission business, or the PTB business, which will be vested in a separately listed company, that is Triveni Power Transmission. This in turn will enable independent value discovery and unlocking of value for the companies, and in fact shareholders of Triveni Engineering will receive 2 shares of Triveni Power for every 3 shares held. Lastly, let's keep an eye out on Sudarshan Chem, going with the green on this counter because the board meeting is scheduled on December 13th to consider fundraising via preferential issue.
Okay, all right, got it. Thank you, Vamakshi, for that. So lots and lots of stocks to watch. Let's quickly recap the list then. The ones that have positive news flow: Senco Gold, IOB, HG Infra, NTPC Green, BEML, PNC Infra, Shriram, AMC, Triveni Engineering, and Sudarshan Chemicals. The only stock with negative news this morning is actually Office Space Solutions. All right, let's take a quick break on that note. Come back on the other side, and we will connect with Deven Choksi for some fundamental stock talk. Welcome back. Here with us on Bazaar Morning Call. Well, yesterday in the morning, you heard Nigel, me and Mangalam, of course, discuss the wealth creation study from Motilal Oswal. We had Mr. Ramdev Agarwal with us here in the studios. He was telling us about how the concept for this study is, creating wealth out of bruised blue chips. And Prashant, I know in the evening you had another extended panel with some of these, I think some examples that the study takes from the past. And we were discussing M&M earlier, how that bruised blue chip then went on to become a huge wealth creator. So it looked like a really interesting conversation, Prashant. What were the takeaways?
I mean, usually we hear perspective from investors,
Yeah.
right? I mean, and there were two investors, Ramdev Agarwal, we heard from him yesterday morning as well, and Amit Goela. Amit Goela is partner of Rare Enterprises, and he's occupied the cable next to Rakesh Jhunjhunwala for 20 years. I mean, I remember when you used to go to meet Rakesh Jhunjhunwala, he would, of course, speak to you, and in the middle of the conversation, he'll shout out for the famous Amit, the one, and he's been the research backbone for Rare over a period of time. But that's the investor set. But we also heard from Mahindra and Mahindra and from Bharti.
Yeah.
Now, both are huge wealth creators, but we don't think of them as, and it came as a surprise to me as well, you don't think of them as, were they bruised blue chips at one point? Actually, they were.
Mahindra, yes. When was Bharti bruised that badly?
Bharti actually got bruised 2 times. One, of course, is back in the day when the regulations and all changed.
Yeah.
And the second time is when Jio came
Jio's
in.
entry. Yeah.
So it was very interesting to hear from the managements of both companies as well on what they did and how they survived, and essentially also the interaction with investors at that point in time. Were investors ready to believe the stories they were telling, etc., etc. So, so let me just quickly play out the interaction. This is, of course, Anish Shah of his group CEO and MD at Mahindra and Mahindra. His experience of, when he took over stock, by the way, the M&M stock is up, I think 4x from the time that he took over. But it was not easy when he came in, and was during the depths of COVID. So just this interaction between, Anish explaining the story. There's Amit Goela, there's Ramdev Agarwal, of course, prodding him along as well. Listen in.
The start of the first phase of my role, the first year was as Deputy MD and Group CFO, began on 2nd April 2020. And that was a time when we had just hit a low point. The stock had lost about 70% of value. SsangYong was a major burden, and we had close to 5,000 crores of losses from what I called our loss-making entities. And as a result, the results of that year were just about break even. And it was the start of COVID and no revenue for the first month of April. So that was the starting point. But the foundation was very strong. And that's one thing I want to highlight in terms of the Bruce blue chip story, is that the foundation had been built over many years, and in fact it was a Motilal Oswal analyst report that in 2018 had highlighted that M&M was the best performing stock in the Nifty since 2002.
Just talk us through, the point that Ramdevji made, external mistakes, internal, sometimes you kind of sort of go astray, large companies. So just talk us through those moments and what you saw.
So let's start with the losses. We knew that we had to address that, and we had to do that quickly. And therefore, we created a list of companies that made that 5,332 crores specifically of losses. SsangYong was highest on the list with 2,400 crores of losses that year. And we said that if we are to be credible, that's the first decision we have to take. And Ramdevji is right. A lot of people at that point said, you said this, but it's not going to happen. And therefore, we had to make that happen. But that wasn't enough, because we still had another 26 or 2,800 crores of losses. And therefore, we had to exit a number of other companies, and we categorized them. We said, look, some of them actually could be good jewels for us if we can turn them around. So our categorization was category A, companies that can be turned around, and they will be companies that we'll be proud of, and they can meet our 18% ROE target. Category B, companies that will likely make some losses but have a quantifiable strategic benefit for us. And category C is none of the above, and therefore they need to exit. And we exited 15 companies in the next 18 months or so. And we just moved very quickly and did that. We did not wait in terms of any sequential order. We just started that simultaneously. So that was the first big step. The second big step was pivot to growth, because just meeting an 18% ROE target is not enough. If you don't see EPS growth as investors, it doesn't matter from an investor standpoint. So we very quickly pivoted to growth from there. And we identified a set of companies that we thought were very strong and what we call the growth gems. And these were strong because they had a strong position in their industry, at least from a potential standpoint. They had a strong, what we call, right to win. And these growth gems collectively had valuation of less than $1 billion in March 2020, close to about 900 million. And the first thing we did there was to say that if you have an aspiration to be $1 billion company standalone, you'll be called a growth gem. And the aspiration has to be matched with a plan that in the next 3 to 5 years, you will be $1 billion company. 3 years later, the collective group had gone from 900 million to 3.4 billion. And we raised the bar. At that point, we said that to stay a growth gem, you've got to now grow 5x in the next 5 to 7 years. So that 3.4 must go to 17. And that's one part of what's driving our growth now, is the ambition as well as the ability to then deliver on each of our businesses.
You communicated obviously very clearly internally. Did you communicate as you were going along externally as well to the outside world, investors, the investor community?
In June 2020, June 12th, 2020, we communicated an 18% ROE target. And the basic response back from investors were, "You're crazy. There's no way you're going to do this." Right?
But how did you arrive at 18%?
Because we just looked at it first to say that, look, if we take 5,000 crores of profit out, or rather losses out, right, that comes in. And here are certain growth targets which we think we can meet. And therefore we said, to be on the safe side, we'll get to 18% in 3 to 5 years. But we got there in 18 months because we could move quickly on getting those losses out, and we could meet certain growth targets that we laid out. So it was a very deliberate target based on here are the specific actions. If we take these actions, we get there.
And all these actions you did, you had a full authority to, because all these companies were collected by Mr. Mahendra with a lot of pain and effort. So did he give you full authority to just chop it off?
So the answer to that is yes. And that is one of the privileges, or I would say that something we're very grateful for, is that the teams were fully empowered. I would, in all cases, go back to Mr. Mahendra and seek his guidance. And he gave very good guidance in a number of areas. And he always used to say that, look, your goal is to create investor value. And you do what's right for the company. And that is how we worked.
Amit, you want to come in as investor's perspective?
Yeah, so I wanted to add two things to this. One, the turnaround becomes all... Sorry. Yeah. I wanted to add two more things to this. The turnaround becomes all the more creditable because it was done during COVID. They made the announcement in August 20, like when you came up and said 18%. So that was in deep COVID. And then the follow through. And I have not seen a more publicly telegraphed and told to investors turnaround which has happened. Quarter on quarter, he would come on the conference call, he would put up the capital allocation chart, and he would say, look, this is what I had said and this is what I'm doing. So all you had to do was to keep listening to the conference calls quarter and quarter, and you would have made serious money. I'm not joking. 20 years I've not seen this kind of a telegraphing of a turnaround which has been happening on a public platform.
Well, we hear about the guidance and what M&M plans to do in the future, but it's always sometimes important and necessary to look back at how the turnaround really was engineered. And these are sort of, stories of battle and, from the depths of COVID. So very, very interesting conversation between Anisha and, of course, as Amit Goyla put it, all you had to do with the benefit of hindsight now was to listen to the conference calls, and you would have, sort of made a lot of money out there. So very interesting chat. We'll sort of continue to play out more stuff from that panel last evening. So
absolutely. Stuff worth, standing up and celebrating, considering They did it when COVID hit, and then they followed through on all of those promises. In fact, we have lots of stocks to discuss, but let's start with this one with our next guest. We have Deven Choksi joining in. Deven, M&M, so we've heard the glorious past, the whole turnaround story, but the question is from here on, I mean, it's been a fantastic stock, right? This year I think, is the second best performer on the Nifty, if not the first. The question is, would you look at any additional exposure to auto as we look at the new year? And if you do, and if you would, then would that money still be allocated to Mahindra & Mahindra?
Yes, very good morning. Well, certainly, I think our larger focus in the current year, 2025, would be on the commercial vehicles. And commercial vehicles would be the one area where probably we believe that higher amount of growth trajectory is possible. Both Mahindra and Mahindra, of course, but I think both Tata Motors and Ashok Leyland have been showing the distinct signs of bringing higher amount of growth to the commercial vehicle segment alone. And that's where we remain relatively more positive about. M&M, I think particularly the kind of turnaround and the smarter turnaround that they have done in their passenger vehicle portfolio is something, a story I think this one needs to script about. Because I think not only from acquiring the design company in Italy, from there on to, I think, completely changing the manufacturing landscape and I think making the entire new model availability in a quicker succession where the consumer got attracted to. So that's where probably I think they wrote a very successful story, I believe. I believe that I think in the electric vehicles too, I think they are writing similar kind of a story. So maybe I think this likely to continue with this particular journey for a few more years as I see it at this point of time. But if you are asking me new allocation of money, I think it will be largely for the commercial vehicle segment of the business, be it in Eicher, Tata Motors, Ashok Leyland, for that matter, M&M.
That's an interesting call. I'm going to remember this one, Deven. Yes, absolutely. CVs have been down in the dumps, but you're saying maybe there's a turnaround in the cycle that 2025 could bring. Nigel?
Well, that's right. Hi, Deven. Good morning and good to see you. When I want to ask you about two companies. One is Senco Gold. You know, we had spotted this company a couple of sessions ago. When it was seeing good amount of delivery-based buying, it's still down close to 25% from the recent peak. Now they're doing a QIP. It appears demand is pretty okay. What's the view on that stock? And Office, Spaces, that's the newly listed company. Plenty of promise. The stock ran away initially, but I'm looking at it, it's still down now 20% from the recent peak. Any view on both these two names?
Not really, Nigel. I think haven't gone into detail about these businesses, so would refrain from putting any comments.
Deven, have you looked at Vishal Megamart?
Well, I guess I think not completely. I think though my company has already covered this particular stock in the IPO, but I'm personally to go into the detail about this USP into this business. But on the face of it, it appears to be a promising one. Maybe I think more details when I meet you next, I think, and we'll discuss.
Right. I know, got that. Deven, hi, good morning. Thank you for joining us. Just a quick word on, actually, you know, if you can pull these names up for a brief bit, because, so look at, say, something like a CEAT. It was interesting, if you can have these intradays up. Sharp rally day before yesterday. Yesterday, complete reversal. You look at something like if you can have the stock up, please. CEAT is the first one. Look at something like a MapMy India. MapMy India, sharp rally the day before and complete reversal yesterday. HEG, something similar, although that's been running up for a while, and HEG also reversed. Something like a Signity, sharp run up day before, just a reversal yesterday, and a sort of dead name like MTNL, which zoomed and then yesterday completely reversed. So just we had that kind of a day yesterday in terms of trade. All right. With that as a backdrop, Deven, I don't know if you have thoughts on any of these specific names, but I want to ask you two names. LIC, the last 1 month, it's come up nicely, about 25% or so. Yesterday, it was sharply lower. And then come in on Greaves Cotton. We highlighted this with the Hormuz yesterday. I mean, that demerger has taken place. Famed investor Vijay Kedia has bought over, I think 0.5% plus kind of stake. Your thoughts here, Deven?
Yeah, Prashant, good morning. Well, LIC looks, I think, certainly more convincing name to me. I think on one side, they're continuously, I think, expanding the reach through the larger amount of, I think, the distribution points that they have been creating. Now the female distribution segment, I think, which the Prime Minister has also unveiled, I think this is also going to create more amount of distributors called agents, I think, for LIC. Likely to, I think, grow that particular space, I think, on the distribution front very systematically. This company has been doing it. Secondly, larger focus on the term insurance plan is basically making more sense vis-a-vis the savings plans. And that's where probably, I think, the higher amount of growth potential is also being seen. More importantly, a regular growth in the investment portfolio and the profit booking thereon is also suggesting that the business of the company is looking relatively, I think, more stable from a perspective of shareholders. And last but not the least, I think in this rally, probably I think the new investors are likely to get attracted into this company because they need to bring down their stake. Government needs to bring down the stake over a period of time. So that is also another good option, I think, that one could look at from buying into the LIC. I believe the downside risk in the stock is limited. Maybe upside could be, I think, around 20% plus in a period of around 12 months to 15 months.
Okay. Devin, I was just looking at the recent PSU order announcements. When small orders, medium-sized orders, they've all been coming through for BEML, for BEL. NTPC Green today, for instance, has announced some solar orders as well. So if I were to ask you for a PSU stock where you think the order inflow is good and execution is also reasonable, is there any stock that you like from this PSU industrials or PSU capex basket?
I believe, I think most of the order announcement definitely, I think, will continue with a higher amount of visibility because the government is releasing these orders in a systematic manner. So certainly, be it you're in a defense play or be it into the railway play, your business is likely to grow systematically from here on. We have been liking the businesses of PEL. We have been liking the business of BEML, HAL. In between, I think there is a situation wherein you are having them expensively traded into the market. Some amount of price correction has happened in this particular stock. And again, I think the market has picked up. But I would think that any correction in the price definitely means a better buy opportunity because we believe that these companies will execute over a period of time, even though the order inflow is regular and the visibility is longer now. But the execution part is not going to happen as fast as I think the market is expecting. And that's where probably you might see the price correction. And that price correction could be a buy opportunity in a given situation.
Okay. All right. Devin, got that. Thank you very much. Good to get perspective from you this morning. You have a good day and we look forward to connecting again soon. We do have to take a very quick break on that note. Come back on the other side and we'll get our technical experts in. Look at some trading ideas with Mitesh Thakkar as well as Sudarshan Sukhani.
Welcome back and hope you're having a good morning. Well, let's get in our technical experts as promised. Mitesh as well as Sudarshan join in on the show. Good morning, gentlemen, and thanks a lot for joining in as always. Well, Mitesh, tell us what's the trade? And today you're starting off on a clean slate because the GIFT Nifty is suggesting we'll start flat. So what would the trade be if that's the case?
Good morning, Raj. Even yesterday and a couple of days back, I've been suggesting that the market is likely to consolidate, and we've had about 3 days of very quieter contracting days. But the good part is that yesterday we got a low of 24,510 on the Nifty, and 24,500, 24,800 looks to be primarily the range for me. So I think closer to 24,540, 530 is your buying area, and keep a stop below 24,450 odd levels. And on the upside, try to take profit as you get past or get near to 24,750, 800. So I think that strategy should be employed, but I would still be slightly biased on the long side. What looks like is that after making a low at 23, 250, 300 zones, we've had first leg of pullback, and now I think it's just taking a breather. So might go through a few days of consolidation, but the overall trend remains on the upside for me. So I would eventually expect the Nifty to get past 24,800 and hit past 25,150 levels.
Got it. Gentlemen, good morning. Prashant here. Sudarshan, what about you? What would you do?
Yeah, good morning. See, the view remains the same. The Nifty is in a short-term uptrend. Now, after that big monstrous move of last week, the markets will consolidate. That's a very natural process. You know, you have big expansion and then consolidation. I'm assuming that this consolidation will eventually end up on the upside, essentially leading to a breakout. And when that will happen is anybody's guess. I can't say. But yesterday the view was buy a dip towards 24,500. We got that. And if you hold long positions, stay with them. Today the same view applies. I don't know whether we'll get that much. But if you get a 50 to 70 point dip, go long and be patient, because that imminent breakout may not come today, may not come tomorrow, but I think it will come.
Okay. All right, gentlemen, let's also talk about individual stocks. Mitesh, what are you working with today?
Good morning, Surbi. I have all buy calls again. Naveen, fluorine comes on the picture. I think the stock, after 2-3 days of pullback, has given a good reversal yesterday. So buy here with a stop at 3,600 for targets of 3,800. HPCL is a buy with a stop at 397 for targets of 418, 419. A buy on Bank of India with a disclaimer that I hold some quantity in my portfolio. So there's vested interest. But from a trading point of view, looks like the stock would head towards 122 and buy here with a stop below 113. And a buy on Geo Financial with a stop at 330 for targets of 350.
Okay, all right. So that is stocks for Mitesh. Darshan, morning. What about you?
Yeah, good morning. I have one intraday short after many days, and that's Colgate. So intraday short in Colgate with a stop above 28.80. Everything else is a buy. We are getting the same pattern, not only today, but on the previous days. Stocks that have corrected are now sideways and ready to break out. This is a long list of such stocks. So my point simply is that wait patiently for those breakouts to occur. Bajaj Finserv is a buy for today with a stop under 1635. Escorts is a buy with stop under 3500. And Granules, which has already started an up move, is a buying opportunity with a stop under 575.
All right. Thank you very much for those trades and that setup view as well, Sudarshan and Mitesh. We speak with you in about 10 minutes from now for your 9-10 trades. We'll take a break, 5 minutes to the pre-open session. We'll also have Shweta Daptardar of Elara Securities, and we talk about the long-term guidance which was shared by the Bajaj Finserv and Bajaj Finance managements yesterday.
Welcome back. You're with us on Open Exchange. We're coming to you live from CNBC-TV18 Motilal Oswal studios. Now, financials are in focus. Yesterday was all about this Bajaj Finance call that the company did with some of the buy side. By buy side, we mean basically investors into the stock. And that got a fair amount of attention. And then, of course, there's a larger issue of the MFI stress and whether the worst of it is behind us or whether there is more pain ahead. Well, let's connect with Shweta Daptardar, Vice President, Diversified Financials at Elara Securities. Shweta, thank you for joining in. Now, first, I know that this was not a call open to you, but you do like Bajaj Finance, as an idea, as a stock, right? So let's start there. Larger NBFCs, what's the thesis that you're working with on Bajaj Finance? And what are some of the growth numbers that you've penciled in your current target?
Yeah, thank you, Surbi. Good morning. So as you rightly mentioned, we like diversified financials. So we like NBFCs which have diversity in their product profile as well as income streams. Bajaj Finance also, from the valuation comfort perspective, definitely fits the bill. Of course, the going has been tough for the entire NBFC space for past 1 year, and rightly so, because of larger stress in unsecured loans credit. So where Bajaj Finance also has been proactive. But if you look at the from the perspective of customer acquisition franchise and perhaps the targets which yesterday Bajaj Finance gave out to the investors in terms of 25% AUM CAGR, and also a similar kind of EPS CAGR, which even we project for Bajaj Finance over next 2 to 3 years, definitely provides a lot of comfort. Also, if you recall, last quarter, the management also spiked the target on credit cost front. So while provision buffers have already been built up, underlying stress sustains, but we believe the larger part of pain is already priced in the stock. So we continue to maintain our positive stance on Bajaj Finance, and we believe that 125 million customer franchise, which the management is targeting over next 2 to 3 years, and the diversity in profile. So I remember they even mentioning getting into or launching MSME finance businesses into corporate leasing. I think that kind of product diversity and income stream is way to go ahead.
Okay, so that's Bajaj Finance. You're saying that the targets given yesterday by the management, broad big target of 25% AUM growth, that's something that you're on board with, and that's what you're working with as well.
Okay, all right. Hi, Shweta. Thanks a lot for joining in. What about the other stocks in the space that you track? Let's talk about two of those stocks that have been big movers in the last 2 years. PFC and REC, they've come off a little bit from the top. What's the view on both of them?
Yeah, thank you, Nigel. So yes, PFC REC has been the investors' darlings for past 2 years, and rightly so. So like given the stress that we have seen in the overall retail credit market across private banks and NBFCs, has definitely caught investors' attention and apprehensions. Against this backdrop, we have continued to maintain and remain bullish on PSU NBFCs such as PFC REC. Although FY25 was a tad slowed year in terms of capex because of elections blips, but we continue to believe that PFC REC are 15% AUM CAGR story for next 3 years with at least 2 to 3 year NPA down cycle, followed by very strong return profiles, which is around 18 to 19%. So I think, and if you even if you compare this kind of matrix vis-a-vis the valuations, so REC as we speak is trading at 1.3x. Forward price to book multiple. PFC, if you deduct its investment in subsidiary and give a holdco discount, it's definitely coming at attractive valuations of just little over 1x. So with this kind of mouth-watering valuations and the strong EPS CAGR, also attractive ROE profile, with a down cycle that we see on the asset quality front, I think this is something one shouldn't miss out at all.
I mean, that's very nicely put, Shweta. Morning. And, in a market like this, I don't think any of us have heard that phrase mouth-watering valuations in a long time. But there you have it, REC and PFC. So good to hear that. And making a strong pitch for those names. Just one bit though, Shweta, is the bet that these companies also will move away from just being power financiers to financing infrastructure broadly? Is that also something which kind of adds to the confidence?
Yeah, morning, Prashant. So, couple of things. See, look, by the regulatory stance, power financiers can invest or diversify into non-power profiles or non-power loans is only to the extent of 30% of their overall loan book. And if you go by PFC REC management commentaries, they have further restricted or brought an internal ceiling of 20%. So on a over 5,000 billion odd book size, barely 20% of your book will be diversified into infra and logistics. I think that should not have a huge bearing either on your asset quality or say earnings profile going forward. Having said that, this cycle is tad different from the previous cycle. The power financiers have strengthened their lending norms. They are diversifying into infra and logistic companies only which carry strong balance sheets with lower debt to equity ratios. Also, we are in whenever the capex picks up, which is like I mentioned, tad slowed. I think we are in an upcycle as far as infra is concerned, and with government stability in place, I think infra and power is the sector to go for next 2 to 3 years.
Okay, and finally, before we let you go, Shweta, MFI. I know you also wrote a note, I think, early in August, flagging off concerns overall on consumer lending and MFI as well. As things stand, there's a big narrative doing the rounds that this will be okay. By Q4, the worst is going to be behind us. No reason to get overly worried. Do you subscribe to that view?
So, Surbhi, I have slightly different view. So, just to begin with, we were amongst the first ones to call out risk on the MFI down cycle. And I think this is still 3 quarters away. So, in fact, credit cards, you might see slight stabilization or recoveries by the end of this year, by the end of this fiscal year, so FY25. But MFI asset quality spike or deterioration would last for another 3 quarters. So your second half or Q3 could be even worse than Q2. And of course, the primary reason that can be attributed to this, as we all know, is over leveraging of the borrower base. The lower bucket delinquency. So if you look at the latest numbers of the TRIF or such other data scrubbing agencies, so you would have seen for PAR 30, the delinquencies have gone as high as over 20% vis-a-vis 14% a year ago. So that's the latest September data. So the delinquencies are higher, recoveries are bottoming, so collection efficiencies are dipping. Microfinance down cycle is going to last for another 3 quarters. Over and above that, the regulatory forbearance. So with self-regulatory organizations like AMFIN and others further strengthening the lending norms for these MFIs would all the more create pressure on their disbursements growth. Further, there is going to be recalibration of operational systems given the tighter vigilance from the regulatory front. So net-net, the key parameters that drive the earnings for this particular sector are very much at abysmally lower levels. So I think MFI cycle, down cycle to last slightly longer. Perhaps we might see recoveries only in 2H FY26 and not before that.
All right. Shweta, thank you very much for that, and interesting conversation and interesting views as well. We take on board some of the calls that you put out, and I'm sure it's helpful for listeners and viewers. So till the next time. So that's the view on NBFCs, MFIs, of course, PSU financiers like REC, PFC, etc. as well. Avenue Supermarts, DMart is the next one we want to shine the spotlight on. Mangalam is standing by to tell us why. Mangalam, morning.
Good morning. So, last week we were talking about how there has been a fair amount of discounting in a lot of the Q-commerce places, and as a result of which the prices aren't as, for DMart's value, isn't, as much as all the other competitors as well. So this morning we have a note coming in from Goldman Sachs. They're saying that the competitive moat is facing increasing pressure, increasing price discounts, will maintain, is something that the company will do to maintain competitive advantage. And as a result of which there is limited growth headroom outside the top 10 cities as well. So they've cut their FY25, 26 and 27 estimates by anywhere between 4 to 6%, accounting for lower revenue growth in the company. They already had a sell call and a target price of close to around 4,000 rupees. They've cut that target price basis this earnings price cut to around 34.25 as well. So pressures continue to mount for Avenue Supermarts.
Okay, Mangalam, and I think the market is taking note of that as well. The stock is down close to around 3% in pre-open. But Mangalam, you're here to tell us about HSBC's stake on PB Fintech as well?
Absolutely. So PB Fintech has been a stock which has, seen a big move in the recent past. HSBC has gone ahead and initiated coverage with a buy rating and a target price of 25.50 on the stock. And the rationale is clear. It's the largest online insurance marketplace that the company operates. And they built strong competitive advantages through scale as well. And it is this scale that will enable their EBITDA margins, as per HSBC, to expand from 3% in FY25 to 19% in FY28. So that's big operating leverage benefit, which would, lead to net profit compounding over the next 3 years at 66% versus revenue compounding of around 27% as well. So it's on this, on the back of this strong growth that they expect the stock can give you another 20-25% from here as well.
Okay, all right, Mangalam. Thanks a lot for joining in and giving us an update on both those two stocks. Well, it's 9:10, so let's get Mitesh and Sudarshan back with us. Mitesh, tell us, what's your 9:10 call?
Yeah. I'll go with the buy on Naveen Flooring for targets of 3,800.
Okay, Naveen Flooring, right? That's the one that you're looking at, Mitesh. Okay, all right. Sudarshan, what about you?
Well, consider buying granules with a stop under 575.
Okay, all right. Thanks for that, Sudarshan. Well, let's get in Vamakshi, who's here to tell us about Triveni Engineering. Vamakshi, they have announced a bit of a rejig. Explain that to us.
Well, absolutely, Nigel. You know, the company will be amalgamating Sir Shadilal Enterprises into Triveni Engineering. Keep in mind that this itself is a separately listed company. Both have manufacturing verticals of sugar and distillery, and this in turn would lead to consolidation of their operations, operational synergies, as well as elimination of duplication. Now, keep in mind that the share entitlement ratio is that the shareholders of Sir Shadilal Enterprises will be receiving 100 equity shares for every 137 shares held. In addition to that, they've also announced the spin-off of their power transmission business, and they believe that they will be listing it as a separate listed entity which will be vested in Triveni Power Transmission. Now this will in turn enable independent value discovery, unlocking of value. You know, power transmission has been the flavor of the season, so definitely some bit of value unlocking out there bodes well for the company. Shareholders of Triveni Engineering will be receiving 2 shares of Triveni Power for every 3 shares that they hold in Triveni Engineering. So overall, this bodes well for Triveni Engineering.
Okay, well, I think stocks up about 1.25% in the pre-open session. Thank you very much, Vamakshi, for that. Let's revisit that guidance which Bajaj Finance Management put out for mutual funds for the buy side yesterday, and we highlighted this with Abhishek towards the closing hour. But the punchiest stuff from that, Abhishek, take it away. Morning.
Morning, Prashant. So, Citi has written on Bajaj Finance. They have a buy recommendation, target price of 8,150 per share. They say that key revisions in the long, term guidance that has been given out by Bajaj Finance over FY25 to 29 includes being a variable payment player, aiming at 1% share in payments. Earlier guidance was of 3% market share, and they will achieve a cost efficiency, implementing 20, artificial intelligence use cases across 25 workstream, which will deliver an annual cost saving of nearly 150 crore in FY26 alone. So, strategy that Bajaj Finance has put in with respect to Bajaj Finance strategy 3 is that there'll be a Fin AI company phase which enumerates, given the fact that SME will be the next growth engine. They will build leadership in key segments like personal loan, gold loans, as well as two-wheelers and microfinance as well. They will optimize auto loans, and they'll launch green financing and corporate leasing as the next phase of growth for them. Back to you.
Okay, green financing. That's another area that they're looking at. Got it, Abhishek. Thank you very much for that. So that's Bajaj Finance. Let's see now that the buy side has had time to digest the commentary and look at it. And there are some notes doing the rounds, like the Citi one that Abhishek mentioned. Maybe let's see if we get some more buyers in. 10 points up on the Nifty. Very quiet in the pre-open.
Very quiet, and in line with the absolute quietness, ho-hum kind of day that we had last night in the US as well. So nothing very much at all. Maybe just a few stocks we have time to put up before we hit the market open. Senco Gold, if we can have this up. So the QIP there, the sort of workspace, sort of renting, sharing company, whatever you want to call it. Senco is up 1.6. AWFIS space. And that should come up on your screen as well. So there's a block deal, private investors selling. I mean, it's nothing on it as well. HG Infra, and there is an order here. So that should also come up. NTPC Renewables, 500 megawatt solar contract. But for companies the size of NTPC Green, the stock's up 4%. This has been a big surprise. I mean, Swiggy is a surprise, but NTPC Green has been the other surprise in terms of the very large issuances which have done well immediately after listing. Shriram AMC, pref issue to Sanlam, smallest, I think, AMC company, but they are building it out. Of course, Shriram Group has Sanlam as an investor in some of the other group companies as well. Take that on board. Just a couple of seconds, and I think we got market open right in queue. What do we have? Nothing very much. Nifty is, kind of flitting between green and red, but in the green for now. 24,620 or so on the Nifty. Nifty Bank is down about 0.25%. We're at about 53,444. The sensex is flat, about 15 points lower. 81,498, 500, round about there. What else? IT index is starting flattish. Again, nothing really on it. Advanced decline is some 2:1, more than 2:1 in favor of what is up. Nifty heat map coming up on your screens, and it is more up than down. Some 38 names, 39 names are higher, and you got a bunch which are lower as well. But more up than down, and there's a grand total of 3-4 points on the Nifty in the first 1 minute of trade. Surabhi.
You know, HG Infra, Prashant, stock that you were just talking about, actually HG Infra, NTPC Green, PNC Infra, all of these stocks that have declared order wins after market hours yesterday. That's where the action is. A bunch of them are doing HAM projects in UP, and then NTPC Green has got a solar order. So wherever there are order wins, that's where the market is getting a little excited. On the quiet moves on the Nifty, let's talk about the gainers. Ultratech Cement, Grasim, Infosys, Coal India, and a Nestle. Now, these are the stocks that are managing at least 0.5% up move or more. Ultratech and Grasim are actually doing really well. Both of those stocks are in leadership position. But then on the downside, there's Dr. Reddy's. There are a bunch of banks like ICICI Bank, Axis, Indusint, HDFC Bank. All the banks have started off on the lower side. Count in SBI as well. The bank Nifty is already slipping. It's down about 0.25%. So that's the one key trend. Other than that, on the gaining side, not much actually. There's Maruti, Hero, some of these auto stocks that have seen profit taking of in the earlier part of the week. There's some buying emerging over there, but otherwise very quiet. Not much on the Nifty.
Well, that's right. You know, from the broader markets, there are a few stocks that are moving around. Raymond, that stock is up closer on 3.5%. Big move is what we're seeing out there. IOB up 4%. You have Enviro Infra. You know, from the time the stock is listed, it's up, I think, closer on 85% from the IPO price. So big move out there. NTPC Green, Vivek has been telling us about, how they are scaling up their capacity. And they as well had joined in on the channel and said that there's a big potential for the EBITDA number to go up many-fold from what we've seen in the past year. So that's one of the big movers as well. What's under pressure? It appears the street is fearing that a bigger player will come into this quick commerce space and disrupt it, so to say. Swiggy and Zomato, both of them are down 2 to around 3.5% in today's trading session. Stocks that actually have been flying high, today they're catching up. It appears that there is some cool-off out there. ITI, Greaves Cotton, as well as Sigility. All of them have pulled off a little bit. Senco Gold had opened up well in the green, so let's see what that stock is doing because of that QIP. That one comes up for you on the screen. Avenue Supermarts, actually that dip that we saw, that's got bought into because the stock is 2% off the low point of the day. Now it's down less than 2%. It was down 3.5% in the first tick itself. So flattish start, but plenty of stocks moving around, Prashant.
Well, absolutely. And, it's what, 10 points to show for it on the Nifty. So let's maybe highlight a bunch of other stocks before we go any further and invite Manishira Chaudhary, who's going to be with us. Raymond has had a fantastic move over the last couple of days. Raymond is up another 3% this morning. Vari Energy is the second largest volume-led gainer. Stocks at about 3,200. Vari, I think about 6 or 7 days back, low was about 2,500. And from 25 to 3,200 in about 6 or 7 days flat. NTPC Green is the number one volume-led gainer. So that is that. Indian Overseas Bank, I think we highlighted. Maharashtra Seamless is coming up with some volumes, about 4% higher, 810. Varroc, and I think we mentioned just a while, 605. Varroc was up 10% yesterday. There is PNC Infra, I think we mentioned, 8%. So these are some of the big movers. And Himmat Singh Ka Seed, about 3% higher. Last few days, we've had these apparel makers, textile companies. Gokuldas, for example, crossed 1,000 rupees day before and was near 1,100 yesterday. And I'm not sure how that is doing this morning, but there's been a big mover, underperformer for a long time, and now starting to catch up with the rest of the market, maybe in a way. So this is what is coming through in terms of at least stuff which has got volumes right now. On the downside, there is Zomato and Swiggy. So there are only two players in that, listed players in that space, and both are down. Swiggy is down 3% and Zomato is down 1.33%. And they both have got decent sized volumes. And two other big movers last 2 or 3 days. ITI, I think, went berserk 20-25% in 2-3 days. It's down 4.5-5%. And Greaves Cotton, which went up sharply. And we spoke about this as well. Greaves Cotton, of course, from 250 levels has rallied very sharply. From 150 levels has come up to about 250 very quickly. That's down about 1.75%. Max Healthcare, Borosil Renewables is down about 4% as well, 570 on that one. And of course, MacMy India which went up sharply day before. Yesterday gave up gains, and today once again is down about 1.25%. Another one is Honasa, which is down 2%, but volumes are nothing to take note of. So we'll maybe we'll look back at it in just a bit.
Just one more point on that, Vare as well as Premier Explosives, both of them, Prima Energy, I beg your pardon, both of them are moving up. I think earlier there was that protection on the solar modules.
Yeah.
Now come 2026, I believe that they're going to be introducing some protection for solar cells as well. And both these two players are getting into some backward integration. The managements, when they came out to the IPO, they told us, right, that they'll be saving on costs because now the cells as well, they'll be sourcing from in-house. So it appears that some kind of play. Though yesterday, Premier Energies didn't run up, but you had Vare that ran up. So we'll have to, check in further detail. Both these two are higher today, though.
No, absolutely. And as I said, I mean, it's come up nicely, 500-600 rupees very quickly in 5-6 days, basically. Well, let's welcome in Manishi Chaudhary. He's Chief Executive Officer, Emma Capital Partners. Manishi, good to see you in your new avatar. Thank you for joining us. It's been a while. So actually, let me just pick up from what Nigel was talking about in terms of stocks, but not stocks so much as policies. Solar and renewables, and I mean, that's, of course, an emerging area here in India. It's got a long runway. Who the winners will be is not so clear, but at least now you've got listed clear pure play options out there. Makes sense at reasonable valuations to buy these companies, because the worry which, the not naysayers but skeptics say is that a lot of this sort of moat is driven by government regulation, government protection more than anything else, because China is such a large producer of everything. Just wanted your thoughts.
Right. In fact, what you asked me just now, first of all, it's a pleasure to appear again, to meet you guys, to meet your viewers on this channel. It's been a while, as you rightly pointed out. This sector, the renewable energy and energy transition in general, it is obviously a growing sector, and there's a characteristic difference between China and India. India, in a sense, is kind of an input taker. Much of these solar panels and the cells, these are manufactured in China, exported to India, and the kind of companies that we do have, they're essentially importing these and putting them together into energy producing utilities. Now, here, one big advantage that the Indian energy producers or even the solar panel manufacturers have is that the input costs are coming down, and that's a direct function of the massive overcapacity that China has created. So yes, I think in the initial part of the runway, the company or the sector in general would have to depend on the government subsidies. Also would have to depend on the policies, the various policies which incentivize investment in this sector. But I think that is likely to be a significantly long runway for India. We must remember that India's net zero ambition goes down to about 2070, which is 20 years after China's. So, I would definitely be quite positive on this sector. The stocks at the right valuations, as you rightly pointed out.
Okay. All right. Got that. Manishi, hi. Great to be speaking with you. So thank you for joining in. I just want to get your thoughts on how to play the consumer side of the market, because there are too many moving parts, right? FMCG companies have been struggling, but look at what's happening to some of the quick commerce or the food delivery plays. Those stocks have been doing well. Those numbers have been improving. And then there is the high-end discretionary consumption, whether it's jewelry stocks or any other format, luxury hotels, and they've been doing really well. Do you expect more of the same in 2025? And what would your approach be to playing the consumer part of the market?
I would expect more of the same, not just in 2025, but possibly for the next decade or two. What you just pointed out is a usual phenomenon when the general population gets more affluent. Not only, things change. Not only do they buy different things, they also buy things differently. It's no surprise that people are buying things more on the online platforms. It is no surprise that they're using more of the, the online and other, UPI-based payment systems. So, the fact that these e-commerce platforms are doing well, the fact that the consumer discretionaries are doing better than the consumer staples, this does not come as a surprise to me. What one has to be very, conservative and has to be careful about are, of course, the valuations. And we keep coming back to this point because in India, possibly more so in India than in any other market, high quality tends to trade at a high premium, in some cases even egregiously high premium. So that is something we have to be careful about. So I would definitely, over the next foreseeable time horizon, be more positive on the consumer discretionary than on the consumer staples. The consumer staples, if you look at the frontline companies, many of them are trading between, say, 40 to 50, in some cases even more, even higher price earnings multiples, with relatively pedestrian earnings growth expectations, about maybe low teens to about 15 to 16%. That doesn't really excite me. And we have seen in the most recent earnings result announcement cycle, most of these companies have actually come up with warnings about both urban and rural consumption moderating. So, even investors who are relatively positive on that sector will possibly have to stay out and wait and watch for a while.
Okay, all right. Hi, Manishi. Good morning and good to see you in your new role. Manishi, tell us about these delivery-based companies, the food delivery companies, the quick commerce companies as well. Zomato, you have Swiggy, both of them are listed, and there is some interest in Zepto as well. I spoke to a large investor yesterday, and he was sounding extremely bullish on the prospects of Zepto. Your view on the space, it's clearly got a lot of traction. They're making the right sounds as well now with their talk towards profitability. Your view?
When I look at these companies, I'm reminded of China about 12 to 15 years ago. Many of the, the present Chinese giants, like Alibaba got listed, I think around 2011 or so. Many of the other companies like Meituan, food delivery, they got listed slightly later, but really started becoming big about a decade ago. So in a sense, what's playing out in India is very similar to the way it had played out in China, maybe a decade or decade and a half ago. The market is still very much underpenetrated. I think e-commerce would be accounting for single-digit proportion of the total retail sector, possibly in low single digits. In case of China, that has gone to somewhere around, I think, close to 50%, if not more. So what these companies would achieve in terms of sector growth and individual top line and earnings growth over the next decade or two is humongous. Now, of course, this is going to be a crowded space. You will have, just like we have seen in China, there will be many companies trying to take advantage of this growth phase. There will be competition which would drive down their margins. So it is something, those factors will have to be watched out for carefully. But as far as the sector growth and, the fate of the leaders are concerned, I would definitely be bullish over the long term.
No, that's a point well taken, Manishi. By the way, since you have tracked Asia Pac and companies around in the region quite closely, some of these companies you mentioned, right? How do they stack up against what one has to pay to be able to buy the companies here? Say size of revenue and valuations, a fraction, right? Of what you pay here.
It's a sad story in that sense. I think most of the Indian companies some of them are trading in triple-digit multiples, right? I mean, they're possibly more than 100p. Many others are in the range of 60, 70 or so. In contrast, I mean, if you look at the Chinese leaders, Tencent or Alibaba, they're trading in their mid-teens. Tencent possibly about 16 times 1 year forward, Alibaba somewhat similar. And their sizes are, you can't even think about, comparing them to the Indian companies at the present stage. Now, of course, one would argue that those companies have gone X growth. I mean, their growth phase of exponential growth is behind them. They're now, kind of more pedestrian growth in the range of maybe 15, 16, 17%. So they deserve to trade at those multiples. They're more mature companies than the Indian ones. So, but that, valuation difference, the valuation gap is a bit alarming.
I mean, and we talk about that every day. Manishi, as I said, it's a pleasure to see you back in your new role. Thank you very much for joining us. And it's always a good chat. So a perspective, but in the context of what's happening around in the region as well. So that's Manishi Chaudhary with that. I mean, the market's up sort of about 10 points or so.
That's quiet, I think, second quiet day. Let's see if it changes as the day progresses. But for the time being, let's talk about the primary market action. It's been a hectic year for the primary market. And even as December is sort of, getting ready to get over, we have some big issues coming in. And the one that we're focusing on right now is Vishal Mega Mart. They are coming out with an 8,000 crore rupee IPO. The IPO is opening out today for subscription. The company has raised about 2,400 crores from anchor investors already. This is an OFS, but the company's had some great credentials, great growth numbers to report, double-digit same-store sales growth, 15% EBITDA margin. So what's the outlook? Well, let's ask Mr. Gurinder Kapoor, Managing Director and CEO of Vishal Mega Mart. Mr. Kapoor is right here with us in the studios. So good to have you on. And I want to start with the first sort of broad question. You've been doing really well, and we'll put up the growth numbers, right? Your margins are pretty good. I think the next competitor comes in as Trent, and Trent has been a fabulous value creator in the market, right? This is an OFS. Why are you coming to the market? Do you need to raise fresh capital, or is it that the market is valuing smart, well-priced retailing businesses very well? So, why wouldn't you want to take advantage of that? What's the thought?
Thank you very much, Surabhi. Thank you very much for having me on your show. It's absolutely a pleasure to be here. As you rightly said, there is no primary in this issue. Yeah. Because by the grace of God, the company has performed well. We have absolutely no debt. We have 700 crores on a balance sheet. We have enough money to finance all our growth ambitions. Yeah. And therefore, this is only secondary. And basically, the promoter group, Samyat, is currently holding about 98% of the company. And they're diluting it to 77%. They will continue to be the promoter company, and they will be invested with us for the long term. They're very excited about the future.
But my question remains unanswered, that you have the capital to fund your store expansion, at least as of now, and you don't have debt, you're cash rich, you're growing. So is it about sort of coming in and joining the listed bandwagon? Because like I said, companies like Trent, they have been really rewarded for hitting the right notes when it comes to the retailing space. So, what are you aiming for with this public listing?
So, as a background, we are largely private equity owned. And the private equity investors, they've been with us since 2018. And as I mentioned, they hold 98%. So it's a slight dilution of their holding in the company. And therefore, it's an OFS. And exactly for the reason that you mentioned, there's no primary.
Okay. Mr. Kapoor, good to have you with us here. Thank you very much. And I can tell you a lot of excitement around this one from investors that we speak with. So what's the revenue trajectory going to be like? Because, I mean, if you look at numbers, revenue is nearly doubled from FY22 levels to about 10,000 crores this year. This 24-25% kind of CAGR, can that continue?
So, Prashant, as you would appreciate, I can't make any specific forward-looking statements. But I can only talk about the last 3 years. Our revenue CAGR has been 26%. Our EBITDA CAGR has been 24.6%. And our PAT CAGR has been 50.9%. For the last financial year, our return on capital employed has been 71%. And just as a matter of record, in the last 3.5 years, we've generated free cash of around 3,000 crores.
But broadly, the answer is yes. I mean, without being very, very specific. I mean, we're not looking for specifics. There's no reason to assume that these numbers will change in terms of growth rates. Or you think...
I'm personally very excited about the future of the company and remain very passionate about serving the middle and the lower middle income group India, which has been our mission.
Sure.
All right. Hi, Mr. Kapoor. And you're quite excited. And I think the street is even more excited about it, going by the talk that we have heard. Let's talk about profitability a little bit. You know, been in that vicinity of around 13 to around 15% in terms of EBITDA margins. Will you be happy at these levels? Do you have some levers in store that you could, take margins even higher from now? Or do you think that 13 to 15% is what you would like to work with?
Broadly in that range, the conceptual approach has been that we will maintain the gross margins at current level.
Okay.
And therefore, we do not see EBITDA, etc., growing through pricing action. That's what we've done over the years. And if we have operating leverage, to that extent, it will show up in the bottom line.
Okay, all right. Got that. So you're quite satisfied at these levels. What about the quick commerce foray? What is the bigger plan? Obviously, it'll be a small part right now, but that's the buzzword as well. So tell us what plans of scaling up on that business.
So it's a pilot that we started, I think, at the beginning of last year, and it's very differentiated. It's a very capital efficient platform. Essentially, it works within a radius of 8 to 10 kilometers of every store. And if you were to log into the app, you would automatically get tagged to the closest Vishal store.
Oh, okay.
And then the inventory of only that store becomes visible to you. And if you were to place an order, you could get, if you so choose, the order delivered within 2 hours. And if you were to buy more than, let's say, 300 rupees, the delivery is free. At less than that, you pay 29 rupees. So it's the early signs have been very good. And I'm quite happy to report that as we speak, we are present in about 390 cities in India through this pilot. And we remain very optimistic.
And the takeoff has been very good for this.
The early signs have been very good because it's just happening as we speak.
Do you see any chance of, going dark with your stores? I mean, if this really picks up?
No, not really, because we have brightly lit stores. So,
but that's important to
but you know
understand.
what I'm saying, right? I mean, so these large stores with people, it's a lot of cost, right?
Absolutely.
As opposed to dark stores, which are maybe less costly to run.
No, but then that would require more separate investment from the rollout of the bright stores.
So
if you plan to roll out the dark
does this come at
stores,
the expense of the other, or I mean?
No, so our retail stores service the customers. So our space is fungible across offline and online, and likewise our inventory is fungible across offline and online.
Okay, just give us a sense of also the mix and the rollout. Because a large part of the revenue right now is coming in from your own private labels, your own brands, apparel, etc. There's also FMCG. So will the product mix more or less remain the same? And to go back to the question, I'm just trying to understand this from your point of view. If we contrast you with some of your currently listed peers, your margins are double that of a, say, D-Mart. But if we compare you to a Trent, which is sort of a more apparel-focused model, then their margins are, double of yours. So just trying to understand how you'll shift this product mix, whether there'll be any changes at all, and whether you will seek, aspirationally, whether you're seeking to grow margins from here. We have no intent historically and even now to change the mix. Approximately 75% of our revenue comes from clothing and general merchandise, as you rightly mentioned, and about 25% from FMCG. Of course, this would change from year to year slightly. And the second thing which you mentioned is absolutely correct. Almost 73% of our total revenue comes from our private brands. Yeah. And of course, our intent would be to, keep it that way.
Okay. Has competitive intensity picked up because all the larger players are there now in terms of this affordable apparel segment after what Zudio has done, right? I mean, and of course, what you've done as well. Has competitive intensity picked up, and how has that changed the game, if at all?
In almost every segment of a business, there is very high quality competition, I would say, both from the online and physical retail. India is a big market, and I suppose that would not change anytime soon.
But does that change the way you do things, or how you will do things in the future? I mean, does that lead to more pressure on what you're able to price products at, etc.?
I think it would be the case that you would have to ensure that you are the best offering for your consumers and customers, because that could be, so to that extent, I think it's very positive that, you just work harder to ensure that for your middle and lower middle income group customers, you are the best offering in the market. And if you were to achieve that, you would, I suppose, be called successful. And
I don't know if there's any market share data at all published to this effect, because it's a very fragmented market and there's the unorganized market. So I don't know if I were to ask you about your market share versus some of your rivals in the value fashion category. Is there any public data? Is there a number you can share?
No,
where is trend? Where are you?
Number.
No, nothing of that sort.
Because
right?
there is one market which is the overall consumption market, and then which is split over organized mom and pop stores and so on and so forth. Then there is the fact that there could be people moving from one to the other.
Sure.
And then within that, it's all of us. So there is really no data. But you can get a sense probably through your growth numbers as to how you're performing. And it's also an indicator of whether what you're doing is relevant for the society in which you're operating or not.
All right. Just one question, Mr. Kapoor, with regard to the agreement that you'll have with Air Plaza, which is your subsidiary, right? Could you explain that to us? Because it seems a little complex, if you could just tell us.
I would, Nigel. And that's a great point. It's a 100% owned subsidiary.
Right.
Historically, the first time when Vishal Retail, the erstwhile Vishal Retail, got sold through the CDR process in March 2011, the front-end company was acquired by, I may get the name slightly wrong, so my apologies for that, Shriram Transport Finance, and the back-end by TPG. So the back-end company was called TPG Wholesale. The front-end was a subsidiary of Shriram Transport, which is Air Plaza. And subsequently, it's all Vishal Mega Mart now. And the fact of the matter is that all our stores historically were under Air Plaza, continue to be under Air Plaza. And if we were to, there is no real reason for keeping it that way, except for the fact that all the store licenses and leases are with Air Plaza. And just for the ease of operations and, avoiding any disruption in the store operations, we are continuing with that same scheme. But the numbers that we report are consolidated numbers because it's a 100% owned subsidiary of Vishal Mega Mart. Yeah, so that's the only reason.
Okay, all right, because some part of the sheet believes it's a little bit complex, but we'll take the explanation that you give us on that. Just one more thing, everyone in their journey has some litigation, some cases, etc. So for the company that's going to list, your investors will want to know whether everything's in the clear as of now. Time to time, there would be something, that the company will have to battle with. But is it all clear right now? Is there any case of worry?
There are all the cases that we are facing in full detail have been disclosed in the DRH.
Indeed, there are a couple of litigations. That's
indeed. And I have a feeling, although that is not what I desire, that would continue because the nature of our business is such that we are operating, let's say, 645 odd stores in clothing, FMCG, general merchandise, and they would always be.
So you don't believe it's any cause of worry from an investor standpoint?
I do the best of my knowledge.
So just finally, with this OFS, the current PE promoter holding comes down to about 76%. You said, right?
Approximately 76, 77.
So anyway, regulatory requirement will require them to dilute to 75% in the coming few years. But beyond that, is there any intent that you can share with us? Do the promoters want to be at 75? Do they eventually want to be at 60? What's the thought process now?
No, and because of the nature of the business, at some point of time they'll want out.
That's a great question. The only thing which I can say with full confidence is because, who can see the future actually that clearly, is that they are very excited about our business. Their intention is to be long-term investors in the company. And I'm personally confident that they would not do anything which would cause any concern to any investors in any which way.
All right, Mr. Kapoor, we'll leave it there. Thank you very much for dropping by to our studios and explaining the business model to our viewers. And good luck with the IPO. Thank you very much.
Thank you very much. Deeply appreciate that. Thank you very much.
Thank you. All right. Well, I think what we're going to do is it's the IPO corner day. I mean, we have, of course, Vishal Megamart explaining their business to you, but we've got one more IPO-bound company joining us in just a bit from now, and that is, of course, from the pharmaceutical space, from the life sciences space. So that's coming up in a bit. By the way, for all that has happened so far, but I mean, it's not as if it's just within the first 1 hour, but there's not very much to show for it at all. It's 4 points lower on the Nifty, 24,600. And if you look at the Nifty Bank or you look at the mid-cap index, the small-cap indices, it's a very, very quiet morning. The management of Sai Life Sciences will join us. Their 3,000 crore rupee IPO opens today. Again, something around which there's a fair bit of excitement. So the MD, CEO and the CFO of the company on the other side.
Okay, welcome back. Let's quickly do an update on the market. Nifty is absolutely flat, so let's see if there are some stocks. By the way, we've sold off a bit from the highest point as well. But on the Nifty, one thing hasn't changed, and that is the way Ultratech is rallying. 2.5% up makes it the biggest Nifty winner right now. Nigel?
Well, that's right. CLSA has come out with a note and they are given 3 big points. One is on pricing, demand, and then in fact in terms of margin. So let's focus on all 3 aspects. They say on pricing that cement prices have been increased by 10 to 30 rupees per bag in early December, which implies that Q3 pricing is higher by close to around 3.5% on a quarter-to-quarter basis. That's Q3 average in comparison with Q2. Though on a year-on-year basis, it's still down by close to around 5%. They're saying that consensus estimates are working with a 4% hike in the second half of the year. So the key to track will be that prices sustain at these levels. We've heard numerous times in the last few months that price hikes have been pushed through, but unfortunately they don't sustain. So sustaining this price hike is going to be very, very important because then in fact they'll meet what the street is expecting for the second half of the year. Next up, in terms of demand, they say that October was a weak month, but they're seeing gradual recovery in demand in the second half of November, and they're remaining positive about a rebound in the second half of this fiscal, and that further seeing, making its way into FY26. So they're expecting FY26 to be a far better year in comparison to FY25. The reason should be obvious, right? This year we had a lot of elections, you had an intense monsoon as well, and various other disruptions during the course of the year. So that's why they're far more optimistic on prospects of FY26. Then they believe that margins could improve from year on because volume recovery will come about, there will be some cost reduction as well, and operating leverage will play out. Ultratech, that they remain selective and they relatively prefer Ultratech is what they say. So could explain why that stock is up by close to 2.5%. And in fact, the cement pack itself is buzzing. Hopes are this price increase will sustain.
Okay, all right. Let's quickly move on and take a look at DMart. Manglam's joining in. Manglam, what's happening with DMart today?
Well, a couple of things that are happening with DMart today. If you look at the stock, which is under pressure today, there has been a Goldman Sachs note that has come in. They've, questioned DMart's own competitive mode. They're saying that it is facing increasing pressure. We've been talking about how quick commerce players have increased the value offerings to customers itself. The management themselves did speak about growth headroom or growth headwinds coming in because of quick commerce itself. And the company has gone ahead and increased their price discounts to maintain this competitive advantage as well. As far as growth headroom is concerned, that's outside the top 10 cities. So to that extent, there will be important, news that we'll watch out for when it comes to store openings for Avenue Supermarts itself. Citing lower revenue growth expectations, Goldman Sachs has cut their earnings estimates for the next 3 years by anywhere between 4 to 6% odd. They have a sell call. They've cut their target price from 4,000 to 34.25 odd rupees itself. Two additional points which may pressurize DMart today. Remember, this is the first negative note that is coming on DMart ever since the stock has entered FNO. So earlier, there couldn't be fresh short positions being initiated. Now the stock is in FNO, so some short positions can be initiated out here. That's point number one. Point number two, we just spoke with the management of Vishal Mega Mart. Vishal Mega Mart, the IPO is offered at a valuation of around 50-55 times 1 year forward earnings, as against DMart's own valuations of close to around 90 times. So maybe there could be that shift that the street is keeping an eye out on as well.
All right, Mangalam, thank you very much for that. So that is DMart with a 2% cut coming through. Look at the, I highlighted the quick commerce names earlier. Swiggy is down 5%, and I think Zomato is down, but less so. Swiggy, of course, is at a sharp run-up post its listing. Now, as promised, let's focus on Sai Life Sciences. That's the 3,000 crore plus IPO, 3,000 crore rupee IPO, which opens today. There's a fresh issue. There is an offer for sale as well. And we have the management now joining us. Krishnam Raju Kanumuri is Managing Director and CEO. And we have Sivaramakrishnan Chittor, who is the Chief Financial Officer at Sai Life Sciences. Both are now joining us to take some questions. Gentlemen, great to have both of you here. Thank you very much for being on the program. Prashant, this side. Krishnam, if I can start with you, briefly, if you can sort of, in a way, pitch your company to your to the viewers who are watching. A little bit about the company. You're in the contract manufacturing space, the CDMO space. Sort of where are most of your clients based out of? What have been growth rates like? And of course, then come to the point of what the money that you are raising is going to be used for. Go on.
So, Sai Life Sciences, again, we're a contract CDMO, but we're a little differentiated from most of our Indian peers. We are more an integrated service provider all the way from discovery services, from when the concepts are started, all the way to commercial manufacturing. We are modeled more like the largest companies in China, WuXi and Pharmaron, which are the most successful companies over the last decade or so. But their strength has always been able to start with companies right at the discovery stage and work with them all the way through commercial launch. This becomes very, very important in today's market environment, where large pharmaceutical companies and biotech companies want to go to market faster, and they want to work with one company as a one-stop shop. So there's no real need for them to move from company to company, which gives them the speed they need. And over the last 5 years, we've re-looked at how to build the company to make it a truly world-class company. And we went and built a world-class campus. We started operations in Manchester, UK, started operations in Boston, Massachusetts, tried to really build world-class talent, world-class ability to the company, and invested in brand new infrastructure. Most of our plants are now built to global standards across the board. And this has really made a big difference for us. If you look at our growth trajectories over the last 3 years, we've significantly outgrown the industry, both in terms of top-line growth of CAGR over the last 3 years, 50% plus in terms of EBITDA margins. And this is really built on a sustained strategy to differentiate ourselves and truly give a world-class alternative. As the world is looking at more decentralized supply chain post-COVID, and these tailwinds are likely to continue for several years, because I think every company we've talked to wants a more robust supply chain of scale. And I think we're well positioned to win business across the spectrum. And given the fact that we work differently from most companies, we have a much broader sales funnel, which people can start with us in discovery, start with us in development or manufacturing. So it gives us a much broader set of service offerings. Also, a customer base. We work with 18 of the top 20 pharma companies, and it's very hard to get that much penetration into the best companies in the world, and we've done that successfully. So I think we're very well positioned for growth as we move forward. The proceeds, we are using majority of the proceeds to pay down debt, to lighten the balance sheet, and also give us the opportunity to expand as opportunities arrive in the market. We are working with a lot of our customers who indicated what they need from both the capacity standpoint and capability standpoint. So we'll deploy these prudently at this point.
All right. Good morning, gentlemen, and welcome to the show. Since around 720 crores will be utilized to repay debt, will you be debt-free post that? Point number one. And on the 700 odd crores, the interest savings will be in the vicinity of around what, 75, 80 crores? Should that be the broad interest saving?
That is correct. I think absolutely right. I think, once you repay 720 crores of debt, we will have very negligible debt. So if you look at what 75, 80 crores of saving, that actually, if you look at FY24, that almost translated around 5.5% of revenue. So they will all translate back into, profit before tax.
Got it. All right. Got that out of the way then. So there'll be some interest savings as well. I just want to understand the financials. As you all were mentioning, that you all have grown quite well. Now, if I just look at FY22 and I compare it with FY24, the revenues are up by what, around 60% approximately. But the EBITDA number has more than doubled. And that's why margins as well have moved to around the 20% odd mark. Could you explain to us how did this happen? The EBITDA number moving, more than twice, and also margin improvement. And should we work with this sort of a margin band, or is there further scope for improvement?
So I think what you're seeing, Krishna talked about setting up the business from a longer term perspective. So 3-4 years ago, we took a stab at saying we will want to transform this business to go compete globally. And we said what would be the ingredients that are needed to get this business set up for a longer term success. And then we identified a few areas, which is people, infrastructure, and then we went about, clinically executing each one of them. Some of them included adding a nearshore center, which is, UK for our process chemistry, and then US for biology. And then we also, made changes to our infrastructure to kind of match global standards in terms of containment, in terms of how we do certain things within the plant. So I think all of these kind of helped us, win new customers. If you look at where we are today, we're working with 18 out of the top 25 pharmaceutical companies. That is as broad as a customer base that you can get to, because the top 20, 25 pharma companies pretty much control all of innovation. And to be with all of them kind of means that there is a lot of room for us to grow as an organization. But in the shorter term, if you really look at, a lot of them will mean increased operating expenditure, also increase employee costs as we kind of stabilize these centers. Also, taking the fact that some of these centers came into operation right around COVID. So there were those initial impacts of COVID that kind of, hit us during fiscal 22 and 23. I think the beauty of the manufacturing business lies in operating leverage. You're exactly right in terms of saying that, profit just jumped from 22 to 24 while revenue wasn't growing at the same clip. Now, The reason for this is operating leverage. And our belief is that the operating leverage growth that you're seeing, just kind of gives you the story in terms of how business can grow when operating leverage comes into play, without getting into any forward statements. But I think, the way we are looking at, we have a lot of, new molecules that we have picked up over the last, 2 to 3 years. Our product portfolio is very young, and, which just tells us that as these products kind of, get to market and kind of grow, there is a lot of potential for our business to grow. That's what we believe.
So the short point you're trying to tell us is, because all the measures that you just mentioned, the margins at these levels are sustainable. Is that correct?
Would not want to make a forward statement.
No forward statement, sir.
What I would like to say is...
No forward statement, sir. This is Nigel on this side. Just want to ask you, maybe 100 basis points lower and scope for improvement. Would that be a broad understanding with regard to the margin trajectory? Because it's improved from 15% to 20%, which is phenomenal because of all the reasons you said. But do you think it can be maintained at these levels?
Our belief is that margins going forward should improve, even further from where we are. Just given the fact that the pipeline is younger, commercial products are getting into larger volumes for our end customer, which would then mean larger manufacturing, which would mean more operating leverage in the business, particularly when you have incurred all upfront costs on our R&D businesses, particularly in UK and US. And then when revenue starts flowing and then commercial revenue starts coming in, the overall expense ratio comes down, and that's where leverage will kick in. And we believe that these are there, and these are exciting times for the business.
Absolutely, and I think your potential shareholders will like the sound of that your margins can improve from 20%, because a lot of the listed peers, they're operating at margins above where you are right now. So you're saying this operating leverage should help improve your trajectory. Mr. Kanumuri, just to come back to the point on growth, and I know you can't give a very specific number for this year, that's fine. But if we just look at the trend, in FY23, the company grew at 40%. In FY24, the growth was 20%. This year, first half, the growth is just about 5%. Now, tell us, what is a sustainable, steady state growth profile? And the reason I ask you this is that there's so much excitement around CDMO companies. Also, just tell us, what are you factoring in from the US market? There's a lot of chatter around this Biosecure Act, whether it's getting deferred and whether eventually Indian companies will benefit or not. So tell us, what is a steady state growth profile, and what are you factoring in terms of fresh regulation on the Biosecure Act from the US when you look at your growth potential?
Look, I don't want to get into future statements, especially steady state, but I think the growth profile is likely to stay strong for the next 5 to 10 years. And I just want to kind of point to the fact that our growth has come in pre even any shadow of Biosecure. I think what has changed in the last 3 years, irrespective of Biosecure, is just a part of the entire global winds changing. Just right after COVID, I think most companies had made the decision that they want a more robust global supply chain. And it's no longer a China plus one supply chain, because they want a supply chain of scale across geographies. And as companies have looked at Europe, US, India more broadly, they realize India is probably the only country which can probably match the scale of China, as well as the cost structure what China can provide over the next 5 to 10 years. So there's a lot of confidence building going on right now with most of the global pharma companies basically working with us more deeply across different product lines, and also giving us much more forward visibility on what is important for them in the next 5 to 10 years. So I would think this trend is likely to continue the next 5 to 10 years because it's strategic in nature. I don't think there's any reflex reaction with respect to Biosecure specifically. It's more a question of companies being comfortable that they have partners globally where they can single and double source, at least double source most of their efforts of scale and quality, which gives them comfort going forward. And India as a country has all the ingredients in place. We've been doing this for 20 years, very strong pharmaceutical background, excellent talent, reliable costs. And I think these will play a big part, not for us itself, the sector itself is going to do well in the next 5 to 10 years.
Is there a way of quantifying that, Mr. Kanumuri? I mean, we understand, but the thing is, I think analysts and everybody is kind of scratching their heads, trying to put some sort of a number to this opportunity. If indeed the Biosecure Act goes through, and if it's not, deferred for too long, then some opportunity, maybe not for your company per se, but for Indian CDMO players overall?
If I had to take a gut feel move, I think if India, let's say pure CDMO opportunity, China must be 30 billion plus in market sales at this point. India is probably in the 2 billion range. Even if I think a minimum of 3 to 4 times in whatever duration, I don't know, but at least I think 20% of the market 20 to 30% market can come to India. And that number itself is very significant from where we are today, which is less than, I would say, 10%.
Krishna, just one last point. How much would private equity players own after all of this? And you've had Sequoia earlier, Tata Healthcare earlier, TPG now, HBM. I mean, what would be? How much would private equity own post issue?
Post issue, I think. Go ahead, Shiva.
I think what I wanted to kind of post issue, TPG will continue to own a little less than 25%, and HBM will own around 2% of the company. But I want to point out is I think the question on the excitement around the industry. I think if you look at the DRHP that we had filed, both TPG and HBM had presented a higher OFS number, but I think they've all looked at where the market is. They've looked at what industry is saying, what global analysts are saying about the CDMO sector being hot. There has been a reduction in the OFS both from TPG and HBM. HBM has been around for more than 10 years. TPG has been invested in the company for more than 6 years.
All right. Got that. Thank you very much for joining us. Good chat, and we wish you all the luck with the IPO. And I think we'll speak again on day one when the company makes it to the public markets. Thank you once again for joining us this morning. Well, PNC infrastructure is what we want to focus on. The stock's up about 11% in trade. Vivek is here to tell us what's moving the stock, the news flow. Vivek, morning.
Well, good morning. So post-market hours yesterday, there was a notification to the exchanges by the company where PNC Infra has said that it's the arm or subsidiary. Hathras Highway has completed a HAM project worth almost 738 crore. What's actually happened is that the company has received a provisional completion certificate, and the company says they're now eligible for an early completion bonus. To give some context of PNC Infra, remember between Q1 and Q2, what actually happened was that the company was barred by MORTH, which is the Ministry of Road Transport and Highways of India, for a period of year. So October 2024 to October 2025, the company and few of its subsidiaries will not be able to participate as far as road projects are concerned. And along with that, the guidance that the management gave at the end of Q1 and also tweaked at the end of Q2 was the fact that the order inflow guidance 13,000 to 15,000, they maintain that, but they're actually expecting a revenue decline as far as the top line is concerned between minus 15 to 20%. So again, this particular news positive, but to be seen in the context of the fact that the company will not be able to participate in MORTH projects for the rest of the year.
Okay, that's an important caveat to keep in mind. Thanks very much for giving us the details there, Vivek. Right now, the stock's been surging almost 10% higher. We do have to take a very quick break, come back on the other side, and some more trading ideas coming up with Mitesh in just a bit. Welcome back. Well, let's quickly get to Mitesh and look at some more trading calls that one can work with. Mitesh, what's the view now? Index? Any fresh stock ideas?
So the index still, isn't something which I'm very positive upon. I mean, it's still showing signs of contraction and, sideways activity. So not much happening over there. But metals is something, which is coming on the radar. Hindalco, I would recommend a buy with a stop at 666 for targets of about 700. And the JK Cement, after a few days of sideways activity, is breaking out today. So buy here with a stop at 4680 for targets of 4800.
Okay, all right, got that. Thank you very much, Mitesh, for the calls. We'll connect with you a little later during the course of the day. So we are going to wind up and take a break. Market's absolutely flat, but watch for the bank Nifty. That's where the pressure is coming in from right now. Nifty Bank is down almost 0.3%. Take a break. On the other side, our special segment, Indianomics, coming up. Lata will be in conversation with a whole host of experts to discuss the tasks ahead before the new RBI governor as he takes charge today.